What's up, everybody? This is Sunko, the Korean bro. Today is 2023, August 7th, and let's start reading article. Okay. The street tech stocks have more than doubled in 2023. Can they do it again? One growth stock down 74% to buy right now. Four key takeaways from Berkshire Hathaway second quarter earnings. SoFi stock, is it a good investment for you right now? Okay, let's see. The street tech stocks have more than doubled in 2023. Can they do it again? Meta's ad sales recovered in the first half of 2023. Nvidia sales of data center GPUs exploded as the AI market expanded. C3.ai's rally was driven by market hype instead of fundamental strength. Nvidia sales of data center GPUs exploded as the AI market expanded. Okay, Meta Platforms. Meta stock sank to a 7-year low last November as its core advertising business sputtered out. Apple's iOS change made it tough for Facebook and Instagram to craft targeted ads with third-party data. ByteDance's TikTok was luring away its younger users, and the macro headwind throttled the growth of the broader advertising market. Meta further infuriated its investors by burning billions of dollars on the development of its virtual reality and augmented reality devices. The Meta stock price has rallied nearly 160% since the beginning of 2023. The market fell in love with Meta again as its advertising revenue grew year over year again in the first and second quarters of 2023. It attributed that growth to surging ad purchases from a Chinese cross-border e-commerce marketplaces that wanted to reach overseas buyers. It also countered TikTok with its own short video platform, Reels, while upgrading its advertising tools to address Apple's iOS changes. As Meta stabilized its revenue growth, it aggressively cut costs to boost its operating margins. As a result, analysts expect Meta's revenue and earnings to rise 14% and 56% respectively this year. Those are dazzling growth rates for a stock that trades at just 25 times forward earnings. Over the next few years, I believe Meta shares could easily double again as it adds even more users to its family of apps, including Facebook, Messenger, Instagram, and WhatsApp, which already serve 3.88 billion people across the world each month. Nvidia. Many investors lost interest in Nvidia last year as its sales of gaming GPUs cooled off in the post-pandemic market, but this year the Nvidia stock has more than tripled as the bulls focus on its accelerating sales of high-end data center GPUs, which are used to process complex machine learning AI tasks. All of the leading generative AI platforms, including ChatGPT and DALL-E, currently use NVIDIA GPUs and expect NVIDIA's brisk sales of data center GPUs, along with the gradual recovery of its gaming business, to boost its full-year revenue and adjust earnings by 61% and 138% respectively. In fiscal 2024, that would represent a stunning acceleration from Nvidia's flat revenue growth and 25% decline in adjusted earnings in fiscal 2023. Adjusted earnings. Adjusted earnings. high multiple could limit its upside potential and set it up for a steep drought of the AI hype dies down. Nvidia's near-term gains might be limited, but it could potentially double its share price again over the next few years if it remains a preferred chip maker of the generative AI market, which Allied Market Research estimate will grow at a compound annual growth rate of 34% from 2023 to 2032. But Nvidia also faces competition from other chip makers in this growing market. It's unclear if it can maintain its technological lead over the long term. Another stock that was caught up in the buying frenzy in AI stock was C3.AI, developer of AI algorithm for large enterprise customers. Its algorithm can be deployed into an organization's existing software to automate tasks, defect fraud, improve employee safety, and optimize spending. C3.AI stock surged nearly 240% this year, but I believe that rally was driven entirely by market hype instead of the underlying growth of its business. C3.AI was previously called C3.Energy and C3 Internet of Things prior to its market debut as C3.AI in 2020. Initially attracted a lot of attention for two reasons. It had a catchy ticker symbol. Its founder and CEO Thomas Siebel sold his previous company Siebel Systems Oracle for $5.8 billion in 2006. But under the surface, C3.ai has some glaring problems. It generates over 30% of its revenue from a joint venture with the energy giant Baker Hughes. But that deal is set to expire in fiscal 2025 and might not be renewed, or else repeatedly change how it counts its customers. Went through three CFOs since its IPO, and abruptly shifted from a subscription-based model to a usage-based one last year. C3.ai's revenue only rose 6% in fiscal 2023, which ended in April. Expects 10-20% growth in fiscal 2024 as the macro environment improves. However, C3.ai is still deeply unprofitable and its stock arguably looks overvalued at 14 times this year's sales. So instead of doubling, I believe C3.ai stock could easily be cut in half in the near future. So he believes that C3.ai is don't have that much value, so its value will be cut in half. So it'd be better for you to sell it instead of holding it. That's his point. Okay. Okay. Now next up is Chewy. Do we have Chewy? The U.S. pet supply and pet care market is one of its strongest and best growing opportunities. Chewy has a unique advantage over rival pet supply retailers. Most of this stock's post-IPO selling is behind it. Now the market just needs the right prompt to begin buying in earnest. Hmm. Chewy. Okay, nothing unusual in Chewy's performance. Don't misunderstand. We've seen plenty of highly touted, publicly traded companies end up importing, punishing all too patient shareholders as a result. Names like Coterra, Groupon, Evan, and Freshly are just some of the names that come to mind. We've also seen many highly rewarding stocks bounce back from a major post-IPO pullbacks. Shares of Meta Platforms back when it was Facebook sold off immediately after its 2012 public offering. It wouldn't start climbing in earnest until the latter half of 2013. Amazon stock wouldn't fully recover losses suffered between 2000 and 2001 until 2009. Prior to Elon Musk's acquisition of the company, Twitter stock soared shortly after its 2013 IPO, but then started a 4-year sell-off that would ultimately drag it more than 90% below its post-public offering peak. The point is, don't jump to conclusions about Chewy just because it's yet another stock that caters shortly after its IPO and pandemic prompted rally. These are growing pains that most young and publicly traded companies go through. Chewy is no exception. Chewy is clearly capitalizing on its strategic advantage. To this end, on the off chance you're reading this and aren't familiar, Chewy is an online pet supply store complete with online pet pharmacy. It's been done before, albeit mostly by brick and mortar pet store chains like Petco, PetSmart. There's room for more than one such platform on the web, though. In fact, there may be room for several of these names. The American Pet Product Association estimates people in the United States alone spent $136.8 billion on their fall babies last year, up nearly 11% from 2021's tally. That's a tough act to follow, but Morgan Stanley estimates the US pen market will still muster annualized growth of 8% through 2030. Clearly, this growth is up for grabs by anyone in the business. Chewy has some of an edge on its toughest competition, however. That's the fact that brick and mortar presence are costing more advantage with less and less physical benefit. Chewy isn't saddled with this baggage. It can wholly focus on optimizing its e-commerce operation. Hmm. And the company is doing just that, as Goldman Sachs analyst Eric Sheridan noted with his recent upgrade of Chewy. There has been increased confidence in more stable customer growth and rising revenue trends. Margin progression driven by gross margin expansion. SG&A leverage as Chewy executes on its supply chain transformation and automation. E-commerce is where the bulk of the market growth is coming from. Data from consumer research outfit packaged facts suggest 36% of last year's total pet spending was done online. Well, off from 2017's proportion of only 16% in 2017, and grew to a figure of 45% as soon as 2026. This is largely part of the unusual post-IPO days. A bunch of would-be buyers remain on the sidelines until it's clear all the pain of selling has run its full course. Mm. The stocks are also not followed by a great number of analysis, at least not yet keeping it off of investors' radars. Meanwhile, many investors wait for more evidence that this company's got the viable future it's supposed to have. Waiting on the sidelines, however, could ultimately prove to be a mistake. The circumstances like the ones currently holding Chewy shares down can evaporate in an instant. A catalyst as simple as an earnings beat could spark what becomes a major recovers rally. To this end, know that Chewy is expected to report the second quarter results sometimes in late August or early September. That may be all you nudge this stock needs. As much of its own stock as it wants. Okay, let's look at details of SoFi. Okay, SoFi. Is it a good investment for you right now? Its gain on sale model for its loan business carries the risk of financial contagion. Gain on sale model. The company expects generally accepted accounting principles net income profitability in the first quarter of 2023. Investors may be overvaluing the stock. SoFi Technologies offer the potential for high returns with its many banking products, but as with any high risk investment, be cautious. SoFi Technologies had investors buzzing with excitement after management released its second 2023 earnings report on July 31st. The stock soared nearly 20% as reported revenue and earnings exceeded analyst expectations, seeing how well the bank performed this year despite recent financial institution failures and the subsequent extreme volatility among banking stocks is incredible. As of July 31st, 2023, the stock was up a whopping 148% for the year. But with such an impressive run over the first half of the year, you might wonder whether it's still a wise investment or if the market is now overvaluing this high flying fintech bank. If you're not the raider, as this article will dive into whether or not the stock is so worth buying. SoFi's landing segment works on a gain on sale model, which means it creates loans and then sells them shortly after to large financial institutions such as banking holding companies instead of keeping them on its balance sheet and earning interest. The disadvantage of this model is the risk of financial contagion disrupting the gain on sale loan market or negatively impacting one of SoFi's large loan purchases. Financial contagion is when a financial crisis spreads from one market or region to another. It can occur at domestic and international levels and disrupt financial institutions across markets connected by monetary and economic systems. This may cause a considerable decrease in demand. Pricing for loans in the US result in a reduced fair value of SoFi's loan portfolio, forcing the company to sell the loans for a lower price than their original worth. SoFi's tangible book value, profitability, and stock price may significantly decline if such an event happens. Financial contagion often catch investors off guard, leaving them with little time to react. Suppose the gain on sale loan market does encounter problems. In that case, it may be too late to prevent significant losses once investors hear the news. Additional product and services, technology, personalization, data driven decision making. Apple, Amazon, Snowflake. Okay, let's start reading about hmm, Snowflake. Let's see Snowflake. The third AI staff Buffett and his team have piled into its data warehousing company, Snowflake. Hmm. The $987 million Berkshire Hathaway held in Snowflake stock as of closing bell on August 3rd, coupled with the company's positions in Apple and Amazon, collectively add up to 47% of invested assets. Snowflake is best known for its cloud infrastructure, which is built atop the most popular cloud infrastructure services, whereas your sharing data can be a potential headache when stored on computing platforms. Snowflake's layered solutions makes data sharing a seamless operation for its members. The being used in 2023 is Snowflake's addition of generative AI solutions to the data cloud of its vendors. Hmm. In May, Snowflake completed its acquisition of Enviva, a company that was powered by generative AI and large language model technology. Hmm. In addition to aiding customers in developing generative AI applications, Snowflake has partnered with NVIDIA, the graphics processing unit designer, retailer seen as infrastructure backbone of high compute data centers. The partnership gives Snowflake users access to NVIDIA's high-powered GPUs. Partnership gives Snowflake's users access to NVIDIA's high-powered GPUs. While there's little doubt that Snowflake finds itself at the center of a high growth trend, it's also apparent just how pricey the company's stock is related to other cloud businesses. Prospective buyers will be paying nearly 15 times sales and 163 times consensus for year earnings to own shares of Snowflake today. This is an especially precarious valuation given Snowflake's full year sales growth has declined on multiple occasions over the past couple of quarters as business push pare back their near term spending. Consider that all next big thing investment take time to mature. Investors would probably be wise to take a wait and see approach following Snowflake's newly announced generative AI push. Uh, This hasn't happened to U.S. money supply since the Great Depression. It's typically accompanied by big moving stocks. M2 money. Hmm. Robinhood money. Apple versus Amazon. Amazon. Let's see. Why did Amazon impress the market? Amazon's growth cooled off last year for two reasons. First, its post-pandemic slowdown in e-commerce sales was exacerbated by inflationary headwinds. Hmm. Second, the macro headwinds curbed the growth of its cloud infrastructure platform, Amazon Web Services, as large companies reined in their spending on big software upgrades. AWS's slowdown was worrisome, since Amazon usually subsidizes the expansion of its lower margin e-commerce business with its higher margin cloud revenue. That's why the bit bulls rejoiced when Amazon's revenue rose 12% year over year to $22.1 million in the second quarter and exceeded analyst expectation by $400 million. AWS better than expected growth along with the expansion of its higher margin advertising business Aggressive cost-cutting measures enabled Amazon to more than double its operating profit to $7.7 billion during the quarter. That trickled down to a net profit of $6.7 million compared to its net loss of $2 billion a year earlier. Amazon's e-commerce business has also been stabilizing as inflation cools off. It continues to expand its higher growth online grocery business. All of those improvements prompted Amazon to guide 9% to 13% year-over-year revenue growth in the third quarter, which would roughly match its 11% growth in the second quarter. Amazon's revenue to rise 9% as it turns profitable again. But next year, analysts expect Amazon's revenue and earnings to grow 12% and 62% respectively as macro environment improves. Amazon might not seem cheap at 54 times next year's earnings, but as an e-commerce and cloud compute company, Amazon is often valued by its sales instead of its earnings. By that measure, it looks dirt cheap at 2 times next year's sales. If I had to pick one over the other right now, I'd buy more shares of Amazon for three simple reasons. Its core growth engines are stabilizing, it's growing faster, and its stock is cheaper. Apple might still be a good safe haven play, but its current valuation could limit its upside potential. Store is far from over. 100-year company is on track to fulfill that pledge. Let's look at Palantir. Alphabet. Okay, data mining and analytics specialist Palantir has been a major beneficiary of Wall Street artificial intelligence rally. Data mining and analytics. But although the company's shares have gained nearly 2.9% so far this year, they still have significant growth potential. Veteran Wedbush analyst Dan Nash seems to agree with this premise. He recently initiated coverage for the company with an outperform rating and a price target of $25. While many companies are now racing to come out with AI-based solutions, Palantir has been offering AI-based services to its clients for the past 2 decades. Palantir has been offering AI-based services to its clients for the past 2 decades. Not resting on its laurels, Palantir has been offering AI-based services to its clients for the past 2 decades. The company launched a new AI platform in April. Palantir AIP enables clients to deploy large language models on the company's internal network and use proprietary data to personalize recommendations, actions, and workflows. new AI platform in April. Under AIP enables clients to deploy large language model on the company internal network and use proprietary data to personalize recommendations, actions, and workflows. Thanks to its customized ChatGPT-like services, AIP has been seeing unprecedented demand from military clients. Hmm. Hmm. While AIP could prove to be a game changer for Palantir in the long run, the company has also impressed short-term investors with its focus on profitability. The company recorded a gap in profits for the second consecutive quarter in the first quarter and expects to remain gap profitable in all quarters of 2023. The company is also free cash flow positive, had $2.3 billion cash and no debt on its balance sheet at the end of the first quarter. There's no doubt that Palantir's pricey stock trading for roughly 21 times sales, hmm, far higher than the software industry's median price sales ratio of 2.4. However, considering that Goldman Sachs expects generative AI to help increase global GDP by 7% or by $7 trillion in the next decade, a well-established AI stock could see much higher prices in the coming months. Okay, this is it for today, and see you tomorrow. Okay, bye bye.